Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Matt, the mortgage guy. How you doing, buddy?
Good, Mike. How you doing?
I'm doing well. So we teased at the end of episode 1, hopefully what people will be considering good news. And I wanted to jump into that. Actually, before I get started, where can people find you?
GreatMortgageBroker.com. Just fill out the quick and easy form. We'll be in touch within 24 hours.
So the thing that I talked about at the end of episode 1 that I wanted to get your thoughts on is I think mortgage rates get better when Powell stops raising. A lot of people, I think, believe mortgage rates can only get better when Powell cuts. I do not believe that is true, and I wanted to dive into that. Any thoughts on that before I get into the details? What do you think?
Yeah, I mean, I think that you're 100% correct, because as we've continued to preach, and every time there's a new meeting, we tell people what the Fed talks about and what they put on their dot plot and what the future plans are has more an effect than whatever happens this meeting. And so, we get some inflation readings that show inflation coming down, and the Fed does, a zero. I think they could even do a quarter hike, talk about, hey, look, we're getting it under control. We're easing back. We're throttling back a little bit. That is going to have a positive effect on interest rates for sure. Yeah. Just that speak.
Yeah. So this is what, again, having been in the business, having looked at this for way too long, that I don't know that a lot of people realize. So historically speaking, the gap, the margin, whatever you want to call it, between the 10-year treasury and 30-year mortgage rates, blended average is 1.5%. Generally speaking, there are times of stress, times of fear where that explodes. We happen to be in one of those times today. Generally speaking, the mortgage rate is roughly speaking 300 basis points higher. So my current belief is we could stay in this larger gap until the Fed comes out and says, hey, all clear. We got this thing whipped. We're not cutting, but we're also not raising. We're going to let the data speak for itself, which I think occurs Q1 of next year. So we still have 3 rate increases coming, in my opinion. But I could see the end of this. And then what will happen, because transactions are going to be decimated the next 4 months, is you'll see banks pull that margin in, and it will easily go back to 1.5. It even can go the other way. And then you add on top of that legislation around first-time home buyers and all of these things. So I think there's goodness coming to housing, but it's not till April, May, June, right? That's my call, that phase 2 is September 15th to March 15th. But again, it's basically why rates will come in is because we have a 2 standard deviation move on the margin between the 10-year and mortgage rates. What do you think?
I like it. I mean, I think that, I haven't thought about that. So it's hard for me to wrap my head around, my thoughts on it, other than it's going to be, much needed relief for buyers and for affordability.
So the other thing to think about, again, is, as you know, or I think I can say, consumer psychology has very short-term memories. So we're through March, we're going to have 30-year rates bouncing around 7, right? I think they go higher, but I don't think they hit 8, but they could. But everybody will be anchored on that. Then we get the all clear. We start getting margin compression, and pretty soon people get excited by 6.5, 6.25.
I can tell you that
6.
I 100% agree with that, and I literally just lived it. Where June we crested above 6, early August was 4.99. You would have thought that it was Christmas morning for some buyers, right? 4.99 just looked so sweet. And I know that after we've seen this, I mean, we only need a few months of 6.5s being written, 6.75s being written for people to look at a 5.5. I mean, myself included, Mike, to be honest. If you showed me a 5.25, if you showed me that I could buy it down to 4.25 or 4.5 for some of these buyers, it would be the sweetest thing since sliced bread. And, we've only been in this higher interest rate environment for a few months.
Yeah, again, rates went up so fast. A lot of people priced out affordability, real estate depression, all of these things that I've been talking about, or housing depression. I'm not calling, again, I haven't changed my opinion on prices. I don't think prices go anywhere for 5 years, but I think transactions, assuming the Fed gives all clear, assuming they've stopped raising, I think margin comes in. I think short-term memory goes, oh my God, honey, we're not getting quoted 7.25. We got or heaven forbid, we got 6.25. We could buy it to 5.9. Woohoo! But unfortunately, you've got 4 or 5 months of pain to get through. But I could see light at the end of the tunnel for the first time.
Right. I like it. I like it. Listen up, buyers. There's light at the end of the tunnel. And truth be told, there's a video that'll be out on my channel on Thursday this week on this 2-1 buy down, where I don't know if me and you talked about it, but I kind of changed my stance on it.
Right.
I was not a big fan of it. Getting somebody kind of anchored and used to that lower payment and having them in a tough spot 2 years from now. But the 2 reasons why I now think that it's a good option for some people, one being the chance that somebody can refinance in the next 24 months, I think has gone up, especially a buyer who's putting 20-25% down. Their ability to be able to refinance into something at 4.99 or 5.25, even if it's paying points to get it, has gone up. The other thing is this seller subsidy. All it is a seller concession to buy the rate down. And for a certain client where I literally showed what we did for this client, 4.5% for year 1, 5.5% for year 2, and then it goes to 6.5 for 3 through 30. So worst case scenario, they're in that 6.5. Let's say that they can refinance in 11 months. Whatever's left of that seller subsidy is sitting in escrow and gets refunded to them. So in a traditional, hey, let's do a break-even analysis, the points that got paid up front to buy down your rate, when does it break even? You don't have to worry about that. That money sits in escrow, and if it's not all used, it gets sent towards principal reduction for the borrower. And so this new twist on this 2-1 buy down, I like it. And looking at it for a client of mine who's buying something at 8.25 at 25% down, and just, it is a move up buyer that moving up by necessity, and it's not going to make sense for them unless we can get creative and do something like this, which I like.
Yeah, I think there's a lot of, so again, one of the things that's very easy to predict, obviously transaction volume, mortgage refis, all of the things are down. So lenders are going to get more creative. They just are. They're going to create new products. Do yourself a favor, folks. Work with a professional who's going to give you the ins and outs of the data. I think there's going to be a lot of people who are starving, and they're not going to have your best interest in mind. They're going to, once again, pitch you the thing that gives them the most money. And that's not what Matt the Mortgage Guy does. And again, if you think you're getting slimeballed by someone, reach out to Matt the Mortgage Guy. He'll give you a quick thumbs up, thumbs down, and maybe tell you you're right, or like, nope, seems like it's okay. And how would they do that?
If you've got something that you want us to look at, you can fire it over to team@mtmg.com. If you go to greatmortgagebroker.com and you look at pre-approved, we'll be with you. But that's a pretty quick glance, right? And I can tell somebody this looks nasty because
this one stinks.
Right. Which I think nowadays I see less. Even it's hyper competitive out there, and the business that is being written, there's multiple people going after it and getting competitive to do it, but it's still worth a look, because I know, companies like Rocket Mortgage, they'll sometimes even just show you something just to see if you'll bite. And then you come to me and I say, this is terrible. You should be paying 3 points for that interest rate. This should cost 1 point. And you go back to them and they go, oh yeah, we can do it for 1.25. So it might be one of those cases, but either way, we're happy to take a look. Team@mtmg.com.
Awesome. Thank you so much.
Thanks, Mike.